Well, it's a very good morning from him, and of course, it's a very good morning from me. I hope you're well. Welcome to my mortgage live stream. I'm Paul Archer. Let's go on air because we're live on YouTube and LinkedIn and Facebook as well. If you're wanting to get across there to take a look at that one, hope all is good with you. It's been a couple of weeks since we had our last live stream because of the bank holiday. But I think bank holidays are over now until next month or month after, I don't know when anyway. So let's crack on with what we got planned for you. Got some updates for you with the new syllabus for the new CMAP. Not a lot of changes this year, but just a few tax changes coming along as well. The reason for that is that the government, or the current government, went for kind of this fiscal drag, or they froze all the allowances pretty much. So nothing really changes year in, year out at the moment. A couple of changes, but we got a few ideas for you to take it forward. So I've got a couple of topics. I've got to take a look at capital gains tax, just a quick refresh, and then one little baby change. And then I want to take a look at dividend taxation. Again, just a little baby change and a bit of a refresh for you as well to keep you up to speed. So let's get on to that, shall we? But before we go there, I've got one funny thing to share with you. Well, not funny really. And then the second thing is a brand new mortgage scheme, which took my eye actually at the weekend. I want to share that with you as well. So let's head over to a few visuals. Now, the one that I picked up in the press, you probably have seen this as well. And this is from the Money Week, which I pick up each week. And there's a picture of an influencer. And down here, the FCA, of course, are now clamping down on finfluencers. These are the people who advertise or promote financially regulated products. There's a few people from The Only Way is Essex and Love Island, which I've not ever seen those programs. My wife watches that. But these people are influencers. You know, it's just the way of the world. But they've been plugging an investment scheme now of high-risk contracts for differences. These are massively high-risk things, and they've been promoting these. They probably don't really understand them, bless them, but they have. And of course, the regulators now clamp down on them, and they could face prison. Now, that's, we're not mucking about there with prison, are we? But they could face. So I think the FCA are making kind of like they're going to make an announcement, and they may go to prison. They may not. They probably won't. I don't know. But it's illegal. You've got to be authorised to be able to give advice online. It's as simple as that. So there we are. Hopefully that'll clear up some of the finfluencing that's going on that's not particularly very good. Anyway, another one took my mind, actually, I was reading at the weekend. And this was from the Bath Building Society. Now, the Bath Building Society is not far from us, a little tiny little mutual, and they're all looking for their little niches, aren't they, the building societies, where they can lend, where brokers would think of them rather than anybody else. And they've come out with a great new mortgage which uses the rent-a-room allowance. I'll share this with you because it's just really very clever. So here's the website of the Bath Building Society, which you can go and dig out if you want to, called Rent-a-Room Mortgages. So let's zoom in a bit more for you so you can see that. The whole point about this particular mortgage is that you can borrow up to 90 or 85%, I should say, loan to value. There we go. And it's known as a lodger mortgage or lodger income mortgage. And what they do is they allow you to have a separate room, which you then rent out to a lodger and earn up to £7,500 a year tax-free. Isn't that cool? So they actually use some of that income towards working out your affordability. But it's based upon the rental income received from that £7,500. Not it doesn't take the full amount. It's a little bit more complicated than just adding it to somebody's salary. But it's very clever, I think. Obviously, to buy a two-bedroom house is going to cost you more than a one-bedroom, but maybe they're looking at that marketplace as well. And they offer a fixed rate, as you can see. The rate of interest isn't too bad. 85% at 5.5%, slightly more than the average maybe. But pretty good scheme, I think. Allows people to borrow, and there's some underwriting how it actually works as well. It's done via a multiplier of 4 times, and then they apply a rental coverage assessment from letting a room in the property to cover up to an additional 4 times income. So you could actually get quite a lot of income arranged via that mortgage. So I think that's really good. I think clever. Hats off to the Bath Building Society for doing that. I love these new little innovations coming in. And little baby building societies can do this. They've got personal underwriting teams, very smart, intelligent people, and they can adapt and maybe a bit more flexible maybe than the big banks who don't really want to get involved in that marketplace because they stack them high and sell them cheap, don't they? So that's just a little update for you on mortgage schemes. Anyway, let's get into my first topic, which is dividend taxation. So I'm heading over there for that one. Let's pop across them and we'll talk about dividend taxation. Now, a little bit of an update for 2024 for you, but not really much of an update, but just wanted to clarify a little bit more about dividends and how they work. But first of all, what is a dividend? Well, a dividend is a payment you earn if you own a company. So we're talking here about limited companies. So we're putting there any kind of limited company. It can be a massive conglomerate like BP or Glaxo, or it could be a tiny little company like Mike's Ice Creams Limited with just the one director. It doesn't matter. The point is that these companies, limited companies, issue shares, and shares are owned by people, and shares pay dividends, divs, if the company makes profits. Simple as that. And if Mike, of course, owns his ice cream limited company and he makes a few bob that year, then he'll pay himself dividends if he wants to. And that's the point about dividends. They are available there to pay you income. So what's the implication then for mortgage advisors then? So you're doing your CMAT 1 and probably you're thinking, well, why am I learning about dividends and limited companies? I'm not going to be advising on this stuff. You might do at one point. So what's the implication? Well, the implication for a mortgage advisor, for her predominantly, is that she's going to be handling people like Mike for a mortgage. And there's a lot of companies like Mike's Ice Cream Company around. I mean, the numbers I dug out recently, in the year 2000, so that's 24 years ago, there were 3 million limited companies in the UK. Now, of course, there's going to be some big million limited companies in that, the Glaxos and stuff, but there aren't that many of them actually. Most of those 3 million were tiny little baby companies owned by one or two directors with, one or two shareholders. Usually people who run their own business, who were a sole trader, converted over to become a limited company owner. Now, in the year 2020, I think this just in the middle of the pandemic, of course, the first pandemic, the first lockdown, the numbers went up to 6 million. So they doubled in 20 odd years. I think it's gone up a lot since then. So you need to dig out some figures. And a lot of those people were sole traders who, of course, are taxed as individuals, aren't they? And they've swapped themselves over to being an owner of a limited company. So why have they done that is the question to ask. Why have they done that? Well, they've done that for a number of reasons. The first reasons is that the tax rates are slightly more favourable. So the tax rates are slightly better for you if you earn through a limited company as opposed to being a sole trader. Currently, there's no national insurance payable on dividends. Currently, say it might be different to when you watch this video. Got a new government possibly coming in as well. But the other big one, of course, is limited liability. If you're a limited company, you have limited liability. Although actually, if Mike borrows money from a bank, he'll have to do a personal guarantee anyway for that lending. So it doesn't actually come across as limited for that kind of borrowing. So how are dividends treated then for tax purposes? Let's wrap that up, shall we? So these dividends then are paid and they're taxed on your income, but they're taxed after other kinds of income. So they're taxed after your other income. Now that's quite important. So I'm going to just give you an example of that one, how that one works. So let's say we've got, let's get a different colour pen here. We've got Tariq, my friend Tariq. In fact, I have one of my best buddies, Tariq, lives over in Bangladesh. Met him a few years ago, nice fella. Keep in touch on LinkedIn. But Tariq is over here in the UK and he earns himself some money from a small limited company and wants to apply for a mortgage. Now, Tariq pays himself, this is the numbers I've given him, a salary of £7,670, but he also pays himself £14,000 in divs because he's the owner director of the company and he can pay himself what he likes, subject to obviously profits have been made in the year. So how's that taxed then? Well, as you can appreciate, of course, we need to deduct the personal allowance. So everyone's entitled to a personal allowance, unless of course you're earning shed loads. So Tariq's got the personal allowance for this tax year is 12,570. There you go. So that comes off of that, wipes out his salary and a bit of his dividends as well, which is great, isn't it? He'll also be entitled to a dividend allowance, div allowance there. Not much now, it's crippling downwards, and the current dividend allowance is just £500. So this is all tax-free money, effectively. So what you then do is you work out what's left over, and it happens to be 8,000. Yeah, let's give you the numbers here: 8,600. Now we've got that, as you can appreciate, by personal allowance less the dividend allowance. The difference 8,600 is 7,670 plus the 14,000. Now that's applied at a special rate of tax, dividend tax. And you need to look those up. You don't need to worry about remembering those. But it happens to be 8.75% because he's a basic rate taxpayer. There's higher rates for higher rate taxpayers and additional rate taxpayers. And that comes in at £752 and 50p. A couple of things for you on that, just to wrap it up. That's the amount of tax he pays, because his salary, of course, is well within the personal allowance. So he's not paying anything on that. And his personal allowance, what's left over, plus the dividends, is being used to wipe out quite a lot of the dividends. So it's only 8.75, so 750 quid. I did the same calculation if Tariq were a sole trader and all of his income was net profits, then he would have paid double that virtually in income tax, because the basic rate of income tax, of course, is 20%. And of course, he'd have to pay national insurance on top of that. So you can see why people do this, because of financial reasons. Now, as a mortgage advisor, if you're wanting to take this into account, you definitely want to get Tariq on for his SA 302. And SA 302 is the form that Tariq can download from his self-assessment when he does his tax, and it confirms exactly how much he's earning for that tax year. And the lender may well take the dividends and the salary into account, but then again, he's not going to get much of a mortgage for that income. But that was just an example. I guess this is all going to change. I can see it changing now. The current government may well get rid of national insurance if they stay in power. The new Labour government may keep it if they get power, and they might do something about dividend tax, because they're not going to change any top rates of tax or any of the headline rates. They're probably going to tinker under the bonnet a bit. So we might see some changes in this, and I'll keep you up to date with that. But that's dividend taxation. Bye. Well done. Well done. Well done. Well done. Lots of change, of course, going on. Elections do that, don't they? And I was reading at the weekend about the election bounce. Have you heard about that? If you go back to the last few elections, the month before the election, there was nothing going on in the housing market. And then the month afterwards, the housing market takes off. It's just a confidence thing by having a new party, new ideas, 5-year term, that sort of thing. So look for the summer to get a bit busy in September. October might start to get busy. Overhearing our neighbours at the weekend, they're a young couple with 2 young kids renting. They're looking to buy a place at this stage. So lots of people coming into the marketplace. So get ready for it. It might get busy again, which would be great. No. Anyway, let's go over to another topic for you, just to again keep you up to date. So welcome over to my other whiteboard here. We're going to take a look at the topic of reducing capital gains tax 2024-25. Just a couple of little baby changes for you for the new syllabus. Now, the emphasis of this particular video is to show you how you can reduce the amount of capital gains tax you pay. We know that it's a tax payable when you own an asset and you sell the asset on later and you make a profit, and capital gains tax is paid. So there's a number of ways in which you can reduce capital gains tax. Let's just summarise some of those for you. First of all, you have your annual exemption, which means that you can make an amount of capital gain and this reduces it accordingly. Now, this is only £3,000 for this tax year, so that's coming down drastically at the moment. So there's not much left of that at the moment, isn't it? So that's one way of reducing your CGT. Quite easy, that one, isn't it? Another one for you is transfer between spouses. So if you have an asset and you want to transfer it to your spouse, you can, and they will therefore become the owner of that asset. There's no capital gains tax. There's no inheritance tax to worry about either. So usually investments get transferred across if the spouse is maybe a lower income taxpayer. That's a jolly useful way of doing things. Dying, oddly enough, you don't have capital gains tax on that. Obviously, inheritance tax rears its head, but that means no capital gains tax comes into it. The one, of course, we're very familiar with, or you may not be, is your principal private residence. That was your first property. If you own a house and it's the one that you live in, it's your principal private residence, then there's no capital gains tax to pay on that. There are some exceptions, of course, but we talk about that more in CMAP 2 and onwards. Now, the issues that have been in the press recently, people who have got multiple homes, you can, if you've got multiple homes, wouldn't that be lovely? If you've got multiple homes and they're not let, that's important, that you can make a decision as to which one you want as your private residence. And you've got a 2-year timescale in order to make that nomination. Ms. Rayner was in the press recently for her property in Stockport. She had a couple of properties. I'm not going to go into it in detail, but there was an issue there for her. But you must rent it. That's the key thing about multiple. Exempt assets. There's plenty of exempt assets. So if you want to buy something that doesn't have capital gains tax applied to it, then that's going to reduce any capital gains tax bill, isn't it? The big one for our purposes are gilts. People say national savings, but national savings doesn't have a growth in the value. It pays you interest, and bank accounts pay you interest, but they don't grow in value. We're talking about products that grow in value as such. So you can have gilts. Of course, you can have ISAs, equity ISAs, exempt, as we know. EISs, VCTs, those sort of things, they're all exempt. Venture capital trusts, woodlands. If you want to go and buy a wood, how cool is that? Get yourself a little wood hut in the top tree, the tallest tree in the whole of the wood. Kid's dream, wasn't it? Chattels, which are bits and bobs around the house. These things are all exempt. And the last one, just to sort of squeeze it in for you then, are losses. If you make a loss from owning another asset and you declare that loss in the same year as a gain on another asset, you can offset one against the other. And you can keep carrying forward losses until you've used them all up. So I don't say don't deliberately make a loss, but if you've got a paper loss, then you could actually show that loss, sell the property, sell the asset, and declare the loss as well. Okay, there are a few other business reliefs. So let's put those over here for you, business reliefs, which you might have read about in the book. Now, business reliefs are essentially when you own a business, a small business, and you have assets in that business, and you may want to pass them on to somebody or sell those assets. But generally, they're for small businesses, farms, that sort of thing is what they're regarding to do. But of course, you can use these in other kinds of businesses as well. And there's 3 to talk about, really. The first one is rollover. Business rollover, they call that. Business rollover is where you have an asset that your business has and you sell the asset and you use the money to buy another business asset, pretty much, isn't it? So my friend, from a few years back, a farmer, he might have had a John Deere tractor, which he sold. Would he make a profit from that? I don't know. If he did, say, he could then use the money from that to buy another tractor. So that's just a silly example, but it shows you how it works. Now you're deferring the capital gains tax until eventually that money gets turned into cash, So it's a business rollover deferment. In the same way, you can have holdover. Now, obviously, these are very similarly named, aren't they? Holdover. And this is where you have an asset and you pass it over to somebody else who then enjoys that asset until he or she sells that asset and pays the tax. Again, you're deferring. I think my tractor example, my farmer friend could give his tractor to his son who's taking over the business, and his son could have the tractor until he sells it. So that's basically holdover. The other one, which is more important really, is business asset disposal relief. I'll put the whole thing there for you. Business asset disposal. Disposal relief. Or BADA. Isn't that a comedian, David Baddiel? Anyway, business asset disposal relief. And what this one comes down to is if you have a business which you're selling, you can make a profit, but pay a lower rate of capital gains tax. It used to be called entrepreneurs relief, which actually has a better title, doesn't it, than business asset disposal relief. But it's an acronym, BADA. Now, the final details there for you. It's basically the first £1 million that you make on the business, £1 million, and you can pay at a nice reduced rate of 10%, which is obviously lower than the current rate of capital gains tax, particularly if you've got £1 million, because you can be a higher rate taxpayer there, aren't you? So that's called BADA. Obviously, a lot more detail, but if you're doing your CMAP 1, this is enough for CMAP 1 questions. If you're doing your financial advisor exams, then of course you need a bit more detail on that, and we've got videos on that on our financial advisor portals. So that's just ways of reducing your capital gains tax. The one that gets me every time is dying. It's just suddenly an awful way of reducing capital gains tax. Puts life into perspective, really, isn't it? Bye. Okay, good work. A couple of updates there for you on our materials. Now, these, of course, are going into our boot camps and into our revision guides and everything else, because obviously we update all those things as we go along. So I just wish you for a great week, really. We're off a couple of days this week, off down to Swanage for a couple of days, which sounds fun. Hopefully the weather will keep going. I've got my bike being fixed up this afternoon, so I might go for a little bike ride later, and a souped up bike. I went in there to get its service done, and I said to the fella, I said, new tyres front and rear. I said, front and rear brake pads need replacing. He says, not a car, he says, it's a bike. It's damn sight cheaper having a service on a bike than it is on a car. So anyway, that's my aspects for today. Anyway, enjoy your time, enjoy your week. As always, there's the member list that you can sign on to if you want to. There's a QR code that gets you in there as well. And we've got lots of things going on. Got a couple of new video series coming up in August as well, which we'll let you watch live. Other than that, I'm going to wish you a fantastic week. Enjoy the sunshine. It's 1st of June today, or was it 2nd of June? So we're into the summer at long last. I'll see you all next week. Bye.